Welcome to Investing Hub presentation on bonds, the cornerstone of fixed income investments. Think of a bond as a loan, except you're the lender, offering funds to an entity like a government or a corporation. In return, you'll receive periodic interest payments, making bonds a reliable source of income. At the end of the bond's term, known as the maturity date, you'll get your original investment back. Bonds may not sound as thrilling as stocks, but they play an essential role in creating a balanced and diversified investment portfolio. In this section, let's break down the key components that define a bond. First, the issuer is the entity borrowing the money. This could be a government, a corporation, or a local municipality. Then we have the principal, or the original sum of money you lend out. The coupon rate is the interest the issuer agrees to pay, typically on an annual basis. Lastly, the maturity date marks when your initial investment will be returned. Together, these components create the backbone of how bonds function as a fixed income investment. Not all bonds are the same. The type of bond you choose will depend on your risk tolerance and investment goals. Government bonds, such as U.S. Treasuries, are considered among the safest investments. Municipal bonds offer tax advantages and can be particularly appealing to high-income investors. Corporate bonds tend to offer higher interest rates to compensate for the greater risk of company default. Finally, zero-coupon bonds don't provide periodic interest but are sold at a discount, allowing you to earn through capital appreciation. Investing in bonds offers several key advantages. Firstly, they are generally more stable than stocks, especially government bonds, making them a good source of steady income. Bonds can diversify your portfolio, offering a way to reduce risk when the stock market becomes volatile. For income generation, bonds offer regular interest payments, which is especially attractive to retirees. Finally, bonds help with capital preservation as your principal is returned at maturity, provided the issuer doesn't default. When comparing bonds to stocks, there are clear differences in risk and return. Stocks offer potentially higher returns but come with more risk, whereas bonds provide more stability with lower returns. With stocks, you own a piece of the company, while bonds make you a lender. Income-wise, stock dividends aren't guaranteed, but bond interest payments are usually predictable. Stocks also experience much more price volatility, while bond prices are generally stable, although affected by interest rates. Even though bonds are safer than stocks, they still carry risks. One of the most important risks is interest rate risk. When interest rates go up, the value of your bond can fall. There's also inflation risk. If inflation rises faster than your bond's interest rate, it erodes the value of those payments. Lastly, credit risk refers to the possibility that the bond issuer may default, particularly with corporate bonds. Make sure to assess these risks before investing. To wrap up, bonds are a form of loan to a government or company that provides steady interest income and returns your initial investment at maturity. They are less risky than stocks and provide diversification to your portfolio, offering stability and predictable income. However, bonds are not entirely risk-free. Interest rate, inflation, and credit risks must be considered. With this knowledge, you are better equipped to understand how bonds can fit into your investment strategy. Thank you for watching, and don't forget to like and subscribe to the channel for more investment tips every week.